Millions of Fios customers, including yours truly, by the way, will be able to watch the NFL playoffs this weekend and the bowl games, too, as Verizon and Disney have reached a deal to keep ABC, ESPN, and other networks on that system. The two sides say details will be released in the coming days. Disney shares are up more than 1% today, Verizon about 1%. But as we head into 2019, this raises the question of how much customers are willing to pay for all this content. Well, let's bring in Porter Bibb from Mediatech Capital Partners and Stephen Battaglio from the Los Angeles Times. Welcome to you both.
Good to be here.
Good to see you.
The answer to your question is pretty simple. They have to have ESPN if they expect anybody to watch, and it's really curious that Verizon, which has with the new CEO this year, advertised heavily the fact that they don't have any real interest in content. They want to be a distributor and stick with the dumb pipes, while their competitors at AT&T and elsewhere are loading up on content.
Yeah, but the market, Porter, has been rewarding that strategy this year. They're a little concerned about AT&T if you look at the share price, and thinking that maybe Verizon has the way to go.
Well, with a single revenue stream, it's not really the way to go, and it's taking a little while for the whole media market to shake itself out, but it's all going mobile, it's all going streaming, digital, video, and Verizon's going to be left at the gate. I think they'll change their tune and come back. They made some overtures last year about acquiring both CBS and Viacom. It's not out of the question that they come back and knock both of those into the Verizon pool.
Stephen, I want to talk a little bit about Netflix, which has been the big dog in this party, Stephen, for a long time. How strong are they? How is the moat around that company? In other words, there are a lot of others who are going to come into streaming hard in 2019. So how inviolate is the Netflix monolith?
The test will begin in 2019 when you have Disney launching an over-the-top streaming service and Warner Media launching an over-the-top streaming service. One thing that protects Netflix somewhat in the short term is that media companies have become accustomed to selling their content to Netflix. It is keeping a lot of TV programs on the air and profitable. It's also extracting a lot of value out of the libraries of TV studios. Look at how Netflix paid $100 million for the rights to stream Friends, which you can watch free on television several times a day on a number of channels. But that's how valuable established content is. Yes, we hear a lot about Netflix signing big name producers, making award-winning or an award-nominated films. Right. But people really gravitate to the content that they know and love, and Netflix is paying a lot for that.
And Netflix shares.
The question is, what happens when these studios decide to take their content and run them on their own streaming sites? That gives them a lot of leverage going forward when negotiations come up again for these programs.
I was just going to mention that Netflix shares are up 5%. I think the best in the S&P 500 right now. Porter, Stephen raises an interesting point that AT&T might be onto here, which is AT&T owns those Friends, right, and is taking $100 million from basically its rival, Netflix, to give them the content. So the Journal suggested, I think over the weekend, maybe all of these media companies should not try to compete with Netflix. Instead should say, just pay us for the rights to this content. Porter, is that maybe the way to go? Don't try to launch a competitor. Just say, look, we've got content, you pay us for it.
Well, in the very, very, very near term, that's not a bad strategy. But long term, Disney and the other major content producers are pulling their content off of Netflix and going it on their own. And there's no question that if you have a library of immensely popular content, you're going to draw a crowd no matter what. And everybody's looking today at Netflix and the 45 million people who supposedly streamed Bird Box. That's if it had gone out as a theatrical feature, it would have been the biggest box office hit in the history of motion pictures. It can't continue, and Netflix is reported for its last quarter a $3 billion negative cash flow. Their off-balance sheet debt is mounting. It's well over $12 billion right now. And when they have to go out and continue to pay huge amounts for top talent, they're going to soon hit the wall.
Yeah, it's not just, well, that's what I'm going to come back and ask you the same question I asked Stephen. How healthy is Netflix? If you paint that kind of picture and you look at the kind of expenditure that they're putting into their original productions, some of which are truly excellent, like Roma, you know, how healthy are the financials? I don't mean to make this whole segment about Netflix, but inevitably that's where we've led it.
Netflix is going to have to do one of two things. They're going to have to create an advertising revenue stream, or they're going to have to raise their prices. And in the past, when they've tried to raise their subscription prices, their membership and subscriber lists have just plummeted right through the floor. So they're in a very, very tight corner right now. And the major content producers and the major talent that has been giving them a lot of headlines, it's going to run out of, it's not a sustainable business model.
Stephen, you agree with that?
The other reason that you have, well, another thing that Netflix has to worry about, you know, these over-the-top services that studios and content providers are developing, they kind of have to be there. They have to do this because of cord cutting. Disney and Warner Brothers and other media companies are going to want a way to reach the consumer's home. Right now, over the top is growing rapidly. Viewers a generation of viewers is becoming accustomed to this being the way they watch television instead of the traditional cable bundle.
But how much room is there, Stephen?
You need a line in there. Well, that's a question. You know, already there are researchers who say that subscribers are already fatigued by the number of services that they have to sort of patch together if they want to avoid cable. But the cord cutting continues, and you really need to, every media company is thinking about how I can get into that home once the cord is cut. They're developing products, they're looking at ways, they're depending on their brands to keep them in front of the consumer going forward, even if the distribution model changes dramatically.